First of all, the debt service numbers are very low. So when we talk about in aggregate, the stock of debt outstanding is high, but with low interest rates, consumers are in a strong position to be able to service their debt. And of course, strong fundamentals with a good job market and a solid economy, which we are continuing to enjoy, all bode well for debt not being a problem. And,
right.
I think when you talk about the consumer overall, right now, the picture is quite good. And you can see that in the spending numbers. I think we'll see later this week. You can see it in confidence numbers holding up. You know, the only concern would be to the extent that if tariffs are put on, the picture deteriorates. But for right now, the consumer is probably unquestionably the strongest part of the U.S. economy.
You know, it is interesting, and this is a little bit from left field, but the fact that people are borrowing so much to sustain their spending power, to me, suggests there's not a negative time preference for money. I mean, this is a big discussion point, you know, at PIMCO and others who say there's maybe a reason why we should have structurally lower or negative rates these days. Do you buy those arguments?
So from my standpoint, when you look at the levels of interest rates, it's not a bad decision, obviously, for consumers to make the choice to borrow on credit. You know, the savings rate is very high, well above levels that you would expect it to see, given the level of interest rates and the strength of household balance sheets. It suggests to me that consumers aren't being forced to take on, credit in order to sustain spending. There's a lot of cushion there, and I think part of what explains the story is they're making a very rational decision in the face of low interest rates that this is a very smart way to be funding their purchases.
Right. Although, Caleb, on the student debt side, we know maybe there's kind of no other option there, given the cost these days. So let's bring this back to the market. Obviously, today there's a big relief rally because of the tariffs being delayed.
Yep.
What now? How would you recommend people have exposure?
Yeah, I think the market wanted to rally, didn't want to sell off just on Hong Kong, right? You have extremely low interest rates. So in terms of the other option that you have, you want to make sure that you're investing in assets that have good cash flows. So if you're investing in negative yielding securities, that's obviously not going to be a winning strategy over time. So yesterday,
one of those obvious things that still needs to be said, I guess.
Right, exactly. So you saw the sell-off yesterday. You're seeing the relief rally today. I think it's easy to forget about yesterday's sell-off. But
the only thing I would say, I mean, when you say investing in negative yielding securities does not do well over time, the TLT, I mean, the ETF tracking basically long-term U.S. Treasury debt is up almost 20% year to date.
Right.
You have people who are in these things because of the price appreciation, and now with all of the talk about central bank moves, maybe adding leverage to those trades.
Yeah, I think you can do that for a little while, and we've probably come to the end of that. I think very difficult position for Jay Powell to be in right now. You saw CPI data this morning, and CPI showed that you should probably be maintaining rates or maybe even raising rates, given where we are in the economic cycle. But the curve is essentially flat, if not inverted, between 2s and 10s. We're right on within 1 basis point of inverting today. So if you're Jay Powell, it's a very difficult decision on how many times to cut. Do you cut in September? Do you cut again in December? Potentially October along the way.